welcome to this explainer. Today, we're unpacking something pretty wild, a situation we're calling the Polkadot paradox. We're going to dive into this genuinely fascinating scenario where a highly upgraded network, one that's actually backed by serious institutional money now, is somehow facing absolutely severe market turbulence. It's this massive clash between brilliant engineering and really harsh market reality, and we're going to break down exactly what's going on. Okay, we got to start with this terrifying number, 1 billion. That's the amount of fake tokens minted by an attacker who managed to bypass security over on the Ethereum blockchain. By taking over admin controls using a forged cross-chain message, this attacker literally minted 1 billion fake tokens and swapped them out to drain 108.2 ETH. When a number like that hits the news cycle, it immediately sends massive shockwaves through the entire crypto ecosystem. And because of those shockwaves, the market panic you're seeing right now is very real. Technical analysis charts show the token's price just bleeding out. It's basically in freefall, trading way under the 1.38 moving average and struggling hard just to keep its head above that critical $1 support level. For a legacy project of this magnitude, seeing the price tank like this naturally makes both investors and developers incredibly nervous. But hold on, here is the absolutely crucial takeaway you cannot miss. The compromised tokens, those were bridged DOT, specifically wrapped for the Ethereum blockchain. The actual native DOT living natively on the Polkadot network remains completely safe and secure. The core protocol was not breached at all. But you know how it is in the emotional world of crypto trading. Just the headline of a DOT hack is often enough to trigger a massive blind sell-off, regardless of where the vulnerability actually happened. Section 1. What is Polkadot exactly? So, to see through all this market noise, let's take a quick step back. Founded by Ethereum co-creator Gavin Wood, Polkadot has evolved over a decade from a simple 2016 white paper into a massive, functioning ecosystem. It pulled in over $144 million back in its 2017 ICO, launched its mainnet in 2020, and now, in 2026, it is hitting major institutional milestones. The entire grand vision was designed to solve a huge problem in Web3, letting independent blockchains securely talk and exchange data without relying on those centralized, vulnerable middlemen. Here's the core concept. Polkadot doesn't just run one single chain. Instead, it actually hosts over 65 independent networks called parachains. Think of them like their own sovereign cities. They define their own rules, their own governance, and their own specific applications. We're talking everything from decentralized finance and tokenized real-world assets right down to mass-market gaming. They are fully autonomous. And that brings us to the real genius of the system, the relay chain. All those independent parachain cities plug directly into this central hub. Because they're plugged in, they don't have to source their own security or try to build a validator network from scratch. They share the pooled security of the main network, and they can instantly and securely message each other. It's honestly an incredibly elegant technical solution to the fragmentation we see all over Web3. Section 2. The Pi Day Tokenomics Overhaul. Now, fast forward to 2026. This is where the story should turn into a massively bullish narrative. For years, institutional investors absolutely hated Polkadot's uncapped inflationary model. But on March 14, 2026, fittingly dubbed Pi Day, Polkadot completely ripped up its tokenomics. They instituted a hard cap of 2.1 billion DOT. They slashed annual token issuance by a whopping 53.6% and dropped the inflation rate from a punishing 10% down to roughly 3%. This was the exact structural fix the market had been begging for, basically transforming DOT from a perpetually inflating asset into one with a strictly capped supply. And adding serious fuel to the fire, we just saw the launch of the 21 shares TDOT ETF right on the Nasdaq. This fund holds actual DOT tokens, with Coinbase acting as the custodian. Guys, this isn't just some fun crypto experiment. It signals major institutional acceptance. It essentially puts Polkadot right up there alongside Bitcoin and Ethereum as a formally recognized, easily accessible asset class for your traditional Wall Street investor. Which brings us to Section 3, the bearish reality check. Because here is where the paradox really hits you. Notice the glaring, almost ridiculous disconnect between the tech and the money. On the tech side, Polkadot is an absolute powerhouse. It consistently ranks in the top 3 for GitHub commits, maintaining 450 to 500 active monthly devs building out those 65-plus parachains. But look at the financial data. The total value locked is hovering at just $1.2 billion. and the stablecoin presence is a tiny $78 million. Compared to rivals like Ethereum or Solana, the capital just hasn't shown up to match the engineering effort. And honestly, it gets starker. Look at this, 0. On April 22, 2026, the entire network generated exactly $0 in transaction fees. When a network that pitches itself as the cross-chain hub of the future generates literally 0 revenue on a given day, it becomes incredibly tough to justify a multi-billion-dollar valuation to traditional investors. That lack of daily organic financial activity, that is the anchor weighing down the price. So why does this disconnect matter to you? Well, if you're trying to trade this kind of volatility, you need to know what you're up against. Regulators report that roughly 70% to 89% of retail traders lose money on leveraged platforms. These exchanges engineer literal addiction loops with flashy UIs, and their internal liquidity engines are algorithmically designed to hunt down retail stop losses. When sudden panic hits, like that Ethereum bridge hack we talked about earlier, retail traders just get completely wiped out by violent liquidation wicks. It makes it absolutely essential to base your thesis on fundamental data and long-term trends, rather than getting chopped to pieces in leveraged day trading. Section 4. Will DOT reach new highs? So where do we go from here? The network is currently offering a solid 5.3% staking yield, but it's clearly struggling with mainstream financial adoption. Analysts are incredibly polarized right now. Technical models that just look at moving averages and price action suggest a pretty conservative near-term range, bouncing somewhere between $1.40 and $2.85. However, if that new institutional ETF access and the Pi Day Tokenomics overhaul finally spark the massive ecosystem adoption developers are praying for, some highly bullish algorithmic outliers actually point to a potential target of $36 in the coming years. Ultimately, we're staring down this massive paradox. Technological excellence is clashing head-on with harsh market reality. You've got world-class engineering, strictly capped tokenomics, and actual Wall Street ETFs in one corner, fighting against zero fee days, low stablecoin liquidity, and brutal chart technicals in the other. So the big question is this network quietly positioning itself for the ultimate Web3 comeback, or is it destined to remain a beautifully engineered ghost town? Keep a close eye on those adoption metrics, because at the end of the day, they are going to be the deciding factor.